Hello and welcome to the Marketplace. It's a Monday afternoon. Here we analyze the market. We're going to talk about the trends and investments and how global development is actually impacting your business activities, especially what is happening in Europe and the UK. On the program today, Standard & Poor's actually reports of a massive wipe off of global equity market as a result of UK's exiting of the European Union. All these and more we'll be looking at here on the Marketplace. The Center for Economic and Business Research, SEBA, pushes for the country's power distributor, ECG, to be completely privatized. All these and more, we are also looking at that here. And the Council for Scientific and Industrial Research, CSIR, is asking government to do more to reduce the post-harvest losses on farms across the country. We'll be looking at these, and you can stay interactive with us if you want to join us. Our Twitter handle is Joy Business, and on Facebook, it's Joy Business GH. For more business stories, you can log on to myjoyonline.com/business. My name is John Kojo Amwako. Marketplace returns right after this break. You're welcome back. And in our first story, Britain's exit from the European Union, that Brexit, is not expected to affect the financial investment sector, at least in the short term. That's according to the acting managing director of the National Trust Holding Company, TNC, Francis Apanka. He attributes this to the weak link between the Ghanaian and global market, but admits a possible impact in the long term. Speaking to Joy Business at the launch of the 40th anniversary of the NTHC, Francis Apanka also stressed there is no reason why investors should be or withhold their investment as a result of the upcoming election.
This is a very difficult question to answer because if you look at the polls, it appears that both sides, stay or leave, are neck and neck. We've heard throughout the campaign a lot of argument, actually, both sides claiming that the other side has got it wrong. We will know after the vote on Thursday. If you go from what the bookmakers are saying, though, it appears as though the situation is that the Remain or the Stay In campaign are going to win. But then again, the pollsters have been wrong in the past, and as have the bookmakers. We genuinely don't know which way the British voters are going to go. Well, from the British perspective, if the...
On the operations of NTAC, short term, I don't think so. Long term, perhaps, because we are in a global market, and we all remember the things that happened in the 89-90 with the subprime mortgage crisis. I mean, it spread throughout the world, but it did not hit us that much because our markets are still not that much integrated into the global markets. But I believe some effects will filter through. Don't forget, Britain is one of our large import and export markets, and we also that there's a way in which the currency can impact our activities here. So I believe there could be some impact, but not immediate, not short term. I don't think so. I've heard a lot about that. I'm not too sure whether it is necessarily true. Ghana has come a long way from those years where elections used to put us on the edge. We've tried it a number of times, and I think that we are pretty confident that we'll go through the elections and maintain our stability. So that perhaps is a perception, more of a perception than a reality. I will advise investors that, look, Ghana has done it before. There is really no reason to think that we are going to do it any differently this time. So I would advise investors to do all the things that they would normally have done if we were not having elections.
And then moving on, Britain's exit from the European Union, that Brexit, is not expected to affect the financial investment sector, at least in the short term. That's according to the acting managing director of the National Investment Trust Holding. And all we did look at that, but then also the impact of Britain's exiting the EU countries affect countries worldwide in diverse ways. Reports say global market have skidded following the unexpected results from the June 23rd referendum, according to Standard & Poor's. 2.08 trillion wiped off global equity market last Friday, the biggest daily loss ever in the history of British market. And also markets in the mainland Europe were also hit by the West, with Milan and Madrid each down more than 12% for their biggest losses. Last Friday, the FTSE, the FTSE index in London, fell more than 8% before regaining some grounds by mid-morning. And the Bank of England, however, said it was monitoring development closely and would take all necessary steps to support the financial market, and this also make sure that it stabilizes monetary policy. To find out more about the current happenings in London and the impact on investment in Africa, we have Russell Padmore of the BBC and investment analyst Samson Aklego here in Ghana, also of Investcorp Ghana Limited, an investment bank and also an economist, all joining us to find some perspective. Russell, you're welcome to the marketplace.
Thank you.
Exactly. At long last, Brexit happened. Now, then we are counting the downside of it. Some are saying, yes, indeed, the Central Bank of England should actually cut down interest rates so they can actually adjust the market and bring it to sight, so the shock will not be as massive. In Africa, we are witnessing some market responding directly, going down. Gold prices have actually seen some significant improvement over the period. Russell, what exactly is the implication of this particular decision by Britain or the UK on Africa?
That's an extremely long question to answer. Quite a lot of things are going to happen between now and the eventual exit of the UK from the European Union. Remember the so-called Article 50, which you will hear a lot talked about in the coming year or so. Article 50 of the Lisbon Treaty is the exit mechanism, which has not been used before. All of the uncertainty now following the Brexit or British exit decision made last Friday, even as I speak to you, the FTSE 100 share index at the London Stock Exchange still down more than 1%. There was a temporary halt to trading earlier in the day. Banks and airlines continue to have their shares hit. EasyJet, the low-cost carrier here in Europe, its shares were down at 18% at one stage, as many of the players in the market, investors, look at the situation and think the EU's liberalisation of airlines, for example, that may be something that might not be useful to British-based airlines anymore. We've seen the British pound sterling falling to a 31-year low against the dollar. Now, all of the influential people are trying to calm the markets here in Europe. The UK's Chancellor of the Exchequer, George Osborne, effectively the British finance minister, he has said the country is ready to face the future. I use the quote, it comes from, quote here, a position of strength. Very interesting, a former governor of the Bank of England, the British Central Bank, Mervyn King, has actually called for calm. Quote from him today, no reason to panic. And it's kind of interesting that European Union leaders are already indicating that maybe they would prefer a British fast exit to express the British out of the European Union rather than wait. We had Germany, France and Italy, their leaders meeting today ahead of a big summit of the European Union. There is an awful lot going to happen between now and the 2, maybe 3 years before Britain finally leaves the EU. A lot of trade agreements may have to be renegotiated. We truly are in uncharted waters.
Okay, but Russell, let's also look at it from this angle. Yes, indeed, these big men and women have spoken. You're talking about the EU, you're talking about the Chancellor of the Exchequer, you're talking about the Central Bank of England, all speaking. But the market is still volatile, responding to some of these, the inflexibilities in the market here. We're looking at the impact in Africa and, for that matter, Ghana, for example, because some analysts are also saying that foreign direct investment to Africa is also going to be affected because Britain, by and large, is going to adjust their budget, and that which would affect investment here in Africa. South Africa is beginning to feel the impact because the FTSE JSE All-Share Index is down by almost over 700 points as we speak, basically. So, I mean, why is the market not listening to them?
I think the situation is investors are quite clever. They often make short-term trading decisions as well as ones for the long term. On the long-term aspect, there's great uncertainty. In the short term, there's so much market volatility going on at the moment, it's making a lot of players wondering which financial decisions to make. Now, of the impact there may be on the British trading relationship with countries in Africa, there's been talk of an end of British outwardness. Of course, what we're seeing now is the British people deciding that they want to stand alone, they want to no longer be part of the European Union. Do remember the EU itself is responsible for trading with various parts of Africa. There's also a large European Development Fund, for example. The UK contributes about $585 million every year to this the EU-wide development fund, which is channeling money through the World Bank to various countries in Africa. The UK contributes about 15% of the total EU contributions, which end up largely in Africa. Will all of that change? The EU now will not be in a situation that British money will be going in the coming years. So will the British decide to keep that money back and not invest it in Africa? We will see the trading relationship change dramatically between the UK and countries like Ghana. In the short term, I heard you mentioning the price of gold, which is important to Ghana. Of course, gold is where investors run as a safe haven for their money. This is why the price of gold has gone up significantly. Over the longer term, a lot of talk about the UK perhaps having to maybe get to a situation its trade ties with countries in Africa might be much weaker because of the so-called Brexit. I know the World Trade Organization, the Director General of that organization, recently warned that the UK might have to carry out, I quote here, unprecedented negotiations with 161 other countries. New trade deals may be required. There's talk about the European Union SADC deal, that South African trading group as well, that economic cooperation group. There's a lot to be renegotiated.
Yeah, Russell, you hold it on for me. I do have an economist and also an investment banker with Investport Ghana Limited, as Samson Aklego also on the line, also to give us some perspective here in Ghana. Samson, you're welcome. My first question is, gold is actually going up just because a lot, like Russell did indicate earlier, a lot of investors are finding solace in gold, but oil and cocoa are losing value as a result of that. We are seeing a lot of stock market actually go down from Friday, between Friday and now. The currency, the Ghana cedi, just at this morning, just gained marginally against the British pound and then the euro, but still losing against the United States dollar. What should be the posture or the positioning of our central bank and the finance ministry towards it so we can actually sort of like absorb the shocks that would come as a result of Brexit?
Yeah, sure. Thank you. There are two key things that I think we need to watch. The first one, in the short term, is that I think that we are exposed to the British pound, and because of the Brexit, we're going to see the pound weakening. So immediately, when you take away commodities, of course, you're going to have a mixed reaction because gold is a safe haven, and when it comes to cocoa and oil, you can see clearly the reaction. But what is key for us is our terms of trade. You would observe that when it comes to Britain, we are exposed to them in terms of imports. In terms of the trade of terms dynamics, they're going to have an advantage because the pound is getting weaker. But again, for our exporters, of course, they are going to face a more uncompetitive environment, and of course, the central bank should be able to get us to adjust to that. So the short-term effect really is going to be seen through the currency. But the other element is that when it comes to terms of trade, the adjustment is a bit slower. So it gives a lot of room for the central bank to actually engage the key players in that direction. The other thing is that our financial markets, quite frankly, the adjustment is not going to be immediate as well unless it goes significantly through the dollar. The exposure of the financial market directly to the pound is not very strong because of the way our markets work. Now, the last thing, which is very important, again, is about the concern about UK growth and fiscal adjustments. Again, we must be very careful because if they have to do tax adjustments, if they have to look at public finances in the UK, is going to sincerely affect Ghana in terms of foreign aid and the work of some of the development institutions. And again, we have been told that it's not going to affect us through direct UK support to Ghana. That is quite significant.
Okay.
But it's also going to go through the UK support through the EU.
Okay, Mr. Aklego, you can also hold on. Let me finish with Russell Padmore from the BBC. Russell, the point is now we are there. Economies must adjust going forward. What should you think? What do you think should be the posture of Ghana and Africa for that matter? Because the tendency for the British Central Bank to say, okay, fine, I'm cutting down my interest rate so I can actually adjust the market is very high. What should be the posture of our central banks going forward?
Well, it's kind of interesting that the central bank, of course, has to look at the state of the Ghanaian economy right now as it tries to guide Ghana out of its financial crisis. It, of course, has had the cooperation of the European Union through the IMF for that. I think one sad thing from an African or a Ghanaian perspective would be the loss of a friendly voice in Brussels. There's no doubt about it. A lot of EU policy and the trading relationship with various countries in Africa has been formulated with the help of the UK. There will be that loss of that friendly voice at the table in Brussels when new deals are negotiated. Just look at the agriculture industry, for example. There's often been a complaint from farmers in Africa that there isn't a level playing field. The farmers in Europe are unfairly subsidized. They get money from their various governments, and different deals have been done to level that out in some way to help some countries in Africa with preferential trade access. A lot of that would have been driven by the UK. Now, the British voice in Brussels will be lost from an African perspective, and we could see a shifting of the goalposts on those agricultural subsidies as well.
Russell, fine, maybe in 15 seconds, can Commonwealth help Ghana, for that matter, actually position itself to attract a bit more than what is actually being anticipated from Britain?
I think the role of the Commonwealth now is to make sure that there is an influence over the UK, to remember that Britain has a responsibility to maintain trading relationships with various countries in Africa, to make sure that the so-called Brexit, the exit of the European Union, is not to the harm of various economies in Africa, and to help those economies continue to develop.
Okay, we thank you very much, Russell Padmore of the BBC there. Finally, in 20 seconds, Mr. Aklego, going forward, what do you think, even businessmen and women, exporters and importers, the industry in general, what should we do to curtail the impact on Ghana on this particular situation?
Yeah, I think the key thing that I would say here is that we sincerely, when the currency markets become volatile and we see that the Ghanaian cedi relationship with the dollar and the pound is going to be affected, unfortunately, businesses have to embrace for some amount of interest rate increases or of that nature, because one key way that we can keep the economy stable and ensure that some of the things that we are talking about, if the UK increases their interest rates, in order to keep foreign investors interested in our financial market, especially our government bonds, which we are exposed to foreign investors, we have to make our assets attractive to them. So I think they are looking at what we have done, looking at the expectation about the economy and looking at the inflationary environment. It's unfortunate that the central bank would have to deal, especially if the currency volatility becomes intense, because people are actually uncertain about the developments in the UK economy.
Okay, we thank you very much, Mr. Samson Aklego there from Investcorp Ghana Limited, who is a chartered accountant, an economist and an investment banker, joined us to give perspective and the impact or the implications of Brexit on Ghana and Africa in general. Thank you very much, guys, for your time there. Now, moving on here on the marketplace, the Council for Scientific and Industrial Research, CSIR, is asking government to do more to reduce post-harvest losses on farms across the country. The CSIR says effective steps to deal with the post-harvest losses will be key to reducing the country's food import bill, which currently stands at more than $1.5 billion US. Statistics say up to 30% of the country's total food produced on farms is lost as a result of poor management, according to the Director General of the CSIR, Dr. Lawrence Ajuman. Researchers have already churned out numerous solutions to deal with the problem and now want government to back their work with effective policies. Dr. Ajuman was speaking at the Joy News, the Joy News at the Forum on Food Security in Accra.
$1 million for post-harvest losses alone. And if you take the crops, for cassava, 18%, of the crop is lost as a result of post-harvest losses. For maize, 18%. For rice, 27%. And that is quite important. And you'll find out that the post-harvest loss is almost 70% of the imports that we have. So if you are able to handle the post-harvest losses, probably we may not need even to import and a lot of the crops that we are importing into the country. But when you look at post-harvest losses, it depends on several factors. It could be as a result of getting storage itself. Because if you take maize, there should be crates, there should be other storage systems in place. The other thing is also insect attack. That plays a major role in that. And one of the things we should note is that, unfortunately, most of our agricultural crops are perishable. And therefore, you need immediately, when you harvest, to either store or to process. And that is something that we as a research institute are looking at. There are a number of also these factors that go beyond just research. It goes into policy, it goes into internal mechanism, markets and other things. For example, let me give you a typical example. You can produce, there are certain times during tomato production season, they produce a lot of tomatoes. There's a glut in Nkikesu and all the other tomato. But in Accra, there will be scarcity. And therefore, people will be importing tomato into the country. And therefore, to handle tomato may not be an increase in production. The most important thing will be, how do you have an internal mechanism to transport the tomato from an area of glut to an area where the people need that. It could also be a system where you would have to immediately more or less process the tomato and use. And that is also one aspect that we have as a challenge. We have very little.
The Center for Economic and Business Research is pushing for the country's power distributor, ECG, to be completely privatized. The Kumasi-based policy think tank believes this is the only way to improve the company's fortune substantially. A team including expert trade began a detailed revaluation of ECG's fixed assets last week after President Mahama's recent justification of government's decision to privatize the company. And Sabre says the concession arrangement, which will see government take over the management of ECG privatization after 25 years, will not be prudent. The executive director of the Sabre, Gordon Newlover Samoa, blames the current financial and operational woes of ECG on political expediency.
If I'm going to invest my money, I have to invest for a longer period so that I can get returns on it. Now, assuming that within the 25 years, the private sector is able to turn around ECG and is now profitable, you give it back to government who is inefficient in managing the ECG, and within some few years, it will go back to the problems that we are facing now. So there's no point, let somebody turn the company around and give it back to government to mismanage it again. So for us, we propose that if government is going for partnership, private sector participation, it should be a permanent thing so that they continue to run the organization on a permanent basis so that it doesn't revert back to government for government to come and now interfere, appoint the incompetent board and so on and so forth again. Government as an institution is not efficient in doing business because at any point in time, government is interested in the next vote, in the next election. So policies that will let the government win election is what they will pursue. But they will not pursue business policies that will lead to the organization growing and making sure that they are producing at cheaper cost in the long run for the consumer to benefit. So they may end up employing more people that they don't need. So for instance, if they need like 1,000 people, they may employ about 2,000 people because they need to get job for the boys. And all these things go to increase the cost of operation for ECG. And you and I have to pay through the bills. So when we have competent people on board as private individuals, they know that bringing in so many people that we don't need will increase cost, and that will go against our investment. Therefore, we make sure that we only employ people that we need.
Let's still do some impact of Brexit on Ghana here. And the negotiation with Ghana towards signing the full Economic Partnership Agreement, EPA, will not be affected despite UK's exit from the European Union. That's the assurance from the head of EU delegation to Ghana, William Hanna. Jojoafi has more in this report.
The United Kingdom over the years has been the favorite destination for goods coming from Ghana. For instance, the country earned over £1 billion in revenue in 2014 from exports to that country. Therefore, for some analysts, it's not surprising that the recent decision by a majority of British nationals to vote massively to exit the European Union has got a lot of businesses in Ghana here thinking about the status of the dealings with the UK when it comes to their exports. Some have also argued that looking at the trade relations and volumes of trade with the UK, it is likely that Ghana will abandon discussions on the Economic Partnership Agreement with the EU in order not to miss out on the UK market. But head of the EU delegation to Ghana, William Hanna, says this will not happen.
The United Kingdom remains part of the European Union until such time as these negotiations start and are concluded, and it could take some time. So I don't see any implications at all for the Economic Partnership Agreement. We will continue as before. The basic arrangements that we have put in place, in my opinion, those will continue the negotiations as before. And then we'll have to see further down the line, but I personally foresee great changes there.
Sources close to the EU have indicated that it could actually take about 2 years for the UK to actually exit the economic and political grouping. So firms in the country that export to UK should not be worried about a sudden disruption to their business because of this development. The Economic Partnership Agreement currently guides Ghana's trade with the EU. It ensures that Ghana can export 100% of goods and services to that market duty-free and quota-free.
George, you have for that report, and that brings us to the end of today's edition of The Marketplace. My name is John Kojo Amorko. You can keep your feedback coming in. Our Twitter handle is Joy Business GH, and on Facebook, it's Joy Business. For more business stories, you can log on to myjoyonline.com/business. Have a very wonderful afternoon.